Good afternoon, everyone, and thank you for joining us today. My name is Christina Rose, Director of Strategic Alliances at Foundation Source, and I will be facilitating today's webinar discussing private foundations and donor-advised funds. Before we get started, I want to send my best wishes to you, your families, and your communities. I'm pleased to be joined today by my wonderful colleagues, Marianne Stover, Chief Revenue Officer, and Justin Murphy, Senior Managing Director for the Northern Pacific region. It's a pleasure to have them with us today to talk about the features of and important distinctions between private foundations and donor-advised funds. In the next hour, we will walk through the advantages, considerations, and factors that determine which one is better matched to a client's specific needs. And spoiler alert, sometimes the answer isn't either or, but both. We hope today's session will help you and your team prepare for and navigate conversations around philanthropy with your best clients. For anyone not familiar with our firm, Foundation Source is the nation's largest provider of comprehensive support services for private foundations. Our services include administrative support, active compliance monitoring, tax and legal expertise, online foundation management tools, and philanthropic advisory services. I will formally introduce Marianne and Justin in a moment, but first, a few points before I turn it over to them. This webinar is approved for 1 hour of continuing education credit for CFP, CIMA, CPWA, and RMA certifications. If you provided your ID numbers for your respective certifications when you registered for today's webinar, then there is nothing else for you to do and you're all set. If you did not enter your ID when you registered, but you do want to receive credit, just send me an email with that information after the webinar. My email address is crose, C-R-O-S-E, @foundationsource.com. Now, a quick word about Wi-Fi and phone connections. Probably like most of you, we are working remotely. We don't anticipate any technical issues during the broadcast, but if one of us loses connection, just know that we will quickly get it resolved and resume the webinar. If you experience any problems, you can try exiting and then rejoining the broadcast. Also, audio may be better via phone than on your computer. It will also reduce some strain on your Wi-Fi connection. Questions can be submitted at any time via the GoToWebinar dashboard on your screen. We will be leaving some time at the end of today's presentation for your questions. If we do not have time to answer all of your questions, please know that we will follow up with you directly after the webinar. Lastly, there are some handouts in the handout section of the dashboard that you can access for reference later. One is a comparison sheet between private foundations and donor-advised funds, and the other provides some additional information about Foundation Source. And now it is my pleasure to introduce Marianne and Justin. Marianne Stover serves as Chief Revenue Officer, overseeing the business development team, which she has been a part of for 14 years. In addition to her tenure as the Managing Director of the Mid-Atlantic region, Marianne has extensive experience in philanthropy. She served as Program Officer in the Venture Fund of the Pew Charitable Trust and also Chief Officer for Program Administration in the Trust's Executive Office. A longtime Philadelphia resident, Marianne has also held positions at Temple University, the Jewish Federation of Greater Philadelphia, and Booz Allen in Hamilton. Marianne holds a Master of Law and Social Policy and a Master's in Social Services from Bryn Mawr College. Justin Murphy is Senior Managing Director for the Northern Pacific region, where he works closely with private wealth managers, financial advisors, attorneys, and donors regarding their charitable goals. In this role, he draws upon his background in professional services and the law. Justin previously served in roles at LexisNexis and Thomson Reuters West. Prior to that, he was an attorney at 2 Pennsylvania-based firms, served in the Public Defender's Office of Lancaster County, and as counsel for the Supreme Court of Pennsylvania. Justin holds a law degree from Pennsylvania State University, Dickinson School of Law, and a Bachelor of Arts from West Virginia University. And with that, Justin and Marianne, I turn it over to you.
Thank you very much, Christy. It's very nice to have everyone. Thank you for your time and joining us remotely from your homes, I would assume. And we'll spend the next part of this hour discussing different charitable vehicles, how they can work together, and how you can utilize this knowledge to help you with your prospects and clients, and to raise the topic of philanthropy with those people you're out in the community talking to. So if you've been in the financial services, legal, or accounting industry for any length of time, especially the last decade or so, you know how important philanthropy has become. It's definitely something that's top of mind for high net worth and ultra high net worth individuals, and they are really looking for individuals such as yourselves and their professional teams and communities to help guide them through the different vehicles that are available to understand what's best for them and their family. And unfortunately, if you're not having those conversations with them, then somebody likely is. So that's part of the goal, is to make you feel more comfortable describing the different options and bring them up to your clients proactively instead of waiting for them to bring it up to you. Here at Foundation Source, since this is really all we do, is the working in the world of private foundations and charitable giving, with over 1,600 clients, we have a good sense for different motivators for why clients would want to get more heavily involved in charitable giving. So we can share some of those with you today. Sometimes it's a personal value system, either born out of their own family background, or through their religious upbringings or their teachings of their colleagues. Sometimes it's a sense of community and a responsibility to give back. And sometimes it's an extension of one's own profession or community. And while tax mitigation is definitely a factor, it's usually not the driving force. It's usually kind of on the back end of things. But that being said, there are some very nice tax advantages to setting up either a donor advised fund or a private foundation, and we can discuss those as we move along. So there are two ways to think about this, and the first is through the client lens, as we call it. We see that through clients wanting to establish legacy, impact, community, and lastly, tax and estate planning. So what do we mean by legacy? It's creating a path for future generations of your family. Letting future generations know what was important to you, your family, and those that you love, and establishing a legacy of charitable giving in your own family. So we'll talk about this a little bit later, but we have a lot of families who involve their even very young children in their family foundation, in our case. Why wait till later to teach them the values about thinking about giving outside of themselves? So legacy is a very big factor for a lot of families, as well as impact, especially now with everything going on in the world. Instead of sitting back and waiting for something to happen, actually facilitating change or tackling issues that are important to you or your family right now, and really doing more than just giving money away, actually going out in the communities and getting involved through various activities that you can do through your foundation or your donor advised fund. Community is very important as well. We see a lot of our clients who will want to give back to maybe the academic institution that they got their start at, through their, an organization in their local neighborhood who supported them when they were in times of need, and they want to give back and help out future generations that would benefit from those as well. And then lastly, and it is last for a reason, is the tax and estate planning options. Optimizing short and long-term tax strategies. A very nice vehicle for both foundations and donor advised funds to do that, and that is certainly part of the conversation as well. Now move on to the next one, which would be the advisor lens, which there's probably a lot of financial advisors joining us on the call today. So important for you as far as the analysis of your client. I'm sure most of you are having these conversations already with your clients about what their plan is, what they want to try to benefit in society. We see, Marianne and I have these conversations all the time with advisors, and the very best of them want to be seen as trusted advisors to their families, and they're savvy and knowledgeable about all the different options that are available to their clients. And we've also seen a lot of advisors approach us and use it as a means to win new business. So they may have a prospect that comes to them with an existing family foundation, and they will partner with Foundation Source to come up with a strategy as a partnership to not only manage the money, but also to help administer to the family's foundation. We do this for a lot of our clients and their advisors, where we'll take a look at their existing tax return to see if there are any errors that were made or any best practices that maybe were not adhered to, and certainly putting our knowledge with our large clients base to benefit them in trying to win that business. In addition to that, the advisor acting as the coordinator or the quarterback. So most large wealthy families have a number of professionals that they work with, be it the tax attorney, the estate attorney, if they have a foundation, the grant makers and the administrators for the foundation, the CPAs, and all those individuals working together in tandem to try to help the family achieve their goals. So it's talking through them, through those different professionals, and acting as the main point of contact, if you will. We also see the ability to do things like impact investing, where you can be very entrepreneurial and start a company that is very much charitable in its intent, but also is able to do some very unique things. And a lot of our clients like to have the ability to have their advisor talk through some options with them. And we'll discuss that a little bit further later on down the road. We also talk about the timeline. So in working with so many individuals in this space, it's usually they're involved in some sort of charitable giving already. They're writing checks to their favorite agencies and organizations. But a lot of times they're busy running their company, or they're busy with family, or it could be health issues. So they're all thinking about it. It's just a matter of broaching the subject at the right time and talking to them about whether or not we want to start this early. Do we want to wait until retirement? Maybe kind of dip your toe in the water and set something up now, and then really focus more attention to it as you get closer to your retirement. And a lot of our clients actually come to us and they make their philanthropy their full-time business. That's really what they want to focus their attention on, and we're able to help them do that. And lastly, tied in with all of these concepts is also risk, and most advisors are familiar with the risk tolerance for their clients. How much money do we need to set aside so that we're comfortable when we're finished working? How much money can we set aside towards our philanthropy so that we know that we're making a change? And a lot of people will go all in right from the beginning. They'll put a large chunk of money into their foundation or even their donor advised fund with the intent that they know that's what they're going to do with it, so they'll keep it there. But a lot of other clients approach us and they just want to start very slowly. And you can definitely do that with a foundation or a donor advised fund, where you can put in a small amount. Foundation source would run the foundation for you, or the DAF provider. You can focus on your career and your family, and when you're ready, you can put more assets into it. So Marianne, in the years that we've been working together, we have had numerous conversations with financial advisors, all different types of conversations that have come up. Can you tell us a little bit about how you've approached these conversations and how they've come to you?
Sure. Thanks, Justin. It's great to be here and be joining the presentation and the discussion. You know, when we, as you said, we've been at this for years, and I think we can probably all recognize ourselves in what I'm about to say, at different times, probably wearing a different role in this. That, in my experience, you know, the planning conversations usually head down one of two paths. The first path is, you know, my phone rings or my email pings, and it's an advisor who is about to meet with a client. And when I say about to meet with a client, sometimes it's like right down to the 30 seconds before. But oftentimes, as you know, we get these calls kind of 10 minutes, half an hour before, and really the advisor is kind of looking at this through his or her lens and saying, what do I need to know? Give me a 101 on charitable giving. I think I should be raising this topic with my client, or they've asked me to look at it, and hey, we're now getting ready for the review conversation. Fill me in. And in those types of conversations, the questions usually revolve around, taxes, tax treatment, what's the difference? Like, give me the, like, down and dirty, what's the difference? What do I need to know? And what does it cost? And I think in that situation, again, we've all been caught short on planning and have had to do that kind of work for ourselves over time. I think the setup in that, and the kind of the challenge in that approach is that we're not looking at it through the client lens, but rather we're thinking, okay, I've got to get just the answers to these basic questions so I can go in and kind of have something to talk about. The second scenario is, and I think in more recently in the last couple of years, I think it's probably been more this scenario, which is, my phone rings or the email pings, and it's the advisor preparing for a client meeting. But the advisor, really sets the stage and says, my client is preparing for the sale of the business. There's going to be a significant liquidity event. We're putting together the pieces of an estate plan, and charitable giving is very important to this family. So I want to do some additional research. I want to learn about this, talk to you more about it, go deeper. We've got plenty of time. There's nothing pending today, fortunately, in terms of an estate plan, or, there's certainly advanced planning around the sale of a business. And in that type of a scenario, we're really able to kind of step back and talk about client interests, kind of as you were talking about, Justin, the priority around legacy, the extent to which a family wants to involve the generations, how they may think about short-term plans and long-term plans with respect to giving. And as you very, smartly pointed out, and this is, really based on experience, not just ours, but there's a lot of data behind this as well, that, the tax treatment, again, short-term and long-term, while is significant to people, it's not the driver or motivator for most clients. It's really, the waking up and saying, I've spent decades building my business, and now what? And where's my family in this? And I think when we're able to have those kinds of deeper conversations in the planning process, it just allows us all to do our best work on behalf of the client, and really to step back and say, okay, it's not about fees, that will come. It's not about taxes, that will come. It's not about the portfolio, that will come, but it's really about where do you see the giving and how do you see it playing out in someone's life. And I think that's, that's kind of how I think about this lens. Justin, is there anything that you would add to that based on your experience?
I agree with you 100%. It's usually those two types of calls. Exactly. It's the panic last second. But we're seeing more and more advisors, and not just advisors, CPAs, attorneys approaching us as well about really being thoughtful about things and trying to get a hold of this sooner rather than later. Because again, I don't know what the statistics are. It's something like 98% of clients over a certain net worth, they're already giving, they're thinking about giving, and they just want to be more strategic about it. So I would agree with you 100%, Marian. When you can do it earlier, it's usually a better result.
Great, thank you. Well, I think we're going to use that as a kind of a segue into the next part of this discussion, which is, when there is an advisor mandate and a client mandate around exploring charitable giving and putting some shape to it, it really comes down to trying to figure out how to plot forward and come up with a plan. And that it really does go back to understanding as fully as possible what the client interests are, and kind of, again, recognizing our own interests as advisors in this. And, Justin, in listening to you just a second ago, you reminded me that to put out that when I use the word advisor, like I think generically or kind of as a broad group of people, but it's, attorneys, CPAs, philanthropic advisors, tax lawyers, transactional lawyers, and kind of that, everybody who's kind of in that space and with their specialty. But for purposes of this conversation, I'm just going to call us all advisors or practitioners. But, you know, so with that in mind, you know, when we kind of move to this next phase, which is about information gathering, it's where, you know, the advisor really is kind of putting his or her arms around it and saying, you know, really what does it look like? This is where it's about understanding the various dimensions or attributes of charitable giving vehicles to begin to put the plan together so that there can be guidance and a recommendation coming from the advisor back out to the family or to the decision makers. And to do this most effectively, right, this is where we really dive in. We go from kind of the 101 to the 303 and the 505 on some of this. And it really does revolve around structure, grant making, legacy, investments, charitable deductions, kind of the whole gamut. So I think with that in mind, we'll kind of turn to some of the nuts and bolts around private foundations and donor advised funds. And as a starting point on this, and Justin, you should definitely feel free to chime in on this at any point. You know, as artists and architects would say of the last century would say, you know, form follows function. And I think that also holds true for charitable giving. You know, what it, you know, essentially translates to is that, you know, kind of the shape, again, thinking about architecture or artists, you know, the shape of a building or an object primarily relates to the function, intended function or purpose. And, you know, borrowing from that a bit and thinking about charitable giving, you know, really without getting too wonky or deep into it, you know, the private foundation and the donor advised fund at their very core are fundamentally structurally different entities, and that there are implications of those structural differences. And, you know, that's, again, we're gonna talk through that. Kind of a broad brush strokes, you know, a private foundation is its own legal entity, and with that comes the stewardship and fiduciary responsibility of running an organization and being responsible for that organization. Set out in many of the clients who are moving forward with charitable giving have their own businesses, so they're very familiar with these kinds of structures. So borrowing from kind of a corporate world, right, the private foundation is a philanthropic enterprise or a philanthropic business with its own kind of legal requirements around it. So that's kind of the legal structure, legal underpinning of that. The donor advised fund, in contrast, is a fund or an account at a public charity, and the public charity ultimately is responsible for the entity or the fund and all of its reporting, accounting, and granting and other behaviors. And I think, again, just to kind of put those side by side, that shape, the vessel of each of those, puts back to the family different levels of responsibility and different levels of engagement. I'm going to pause on that note, and any reflections around the structure. And, you know, as a recovering attorney, you might have something more technical to say than I do as the non-lawyer.
I don't want to put anybody through that, but I appreciate that, Marianne. And first of all, I'm happy to get any call anytime, by the way, be it 5 minutes before the meeting or 5 years before the meeting. So call us at any point so we can help out. But I have seen a lot of confusion when so I'm here in San Francisco, covering Northern California and the Pacific Northwest, and I get this all the time where they have a client or a prospect who has a quote unquote foundation, and it turns out it's actually a donor advised fund or a charity. So there's a lot of confusion out there about, just because the name foundation is in the entity, it doesn't really mean it's a foundation. You can name your charitable organization whatever you want to, but just be on the lookout for that. You have to dive a little deeper to find out exactly what type of organization it is. But that's where I've seen some confusion. Have you seen that as well, Marianne?
I have seen that, and I think again for those of us who kind of move in this world, it's probably one of those areas where we begin, and having been around lawyers and working with lawyers for a very long time, I remember to kind of think back to and ask the questions about legal structure. And again, not to put too fine of a point on it, the structure again becomes important for some of what flows through or out of these giving vehicles. I think for a moment, before we kind of go into a compare and contrast on these from a planning perspective, again, it's important to note that both private foundations and donor advised funds at their very core are designed to advance charitable purpose in a tax advantaged way. And it's not surprising that when I say and we say in a tax advantaged way, that the commonalities between the two vehicles often relate back to the tax treatment and kind of the charitable purpose, and also that the contributions to these charitable vehicles, whether it's a private foundation or a donor advised fund, are irrevocable. And it ties to, and I'm having Jeff Haskell, our Chief Legal Officer, sit on my shoulder for a moment. I think it ties back to the tax code and how this comes out of the tax code, which again, form and function, gives us some ways of thinking about the essence of the vehicles. Again, just to kind of highlight a couple of points here, that both the contributions are irrevocable. I said that. I'll say it again because we always get that question of, hey, what happens if the economy turns and I want to get money out of my charitable vehicle, and we'll talk about that as we move along. Both the other points to make on this is that private foundations and donor advised funds both get tax treatment in the year in which contributions are made into the foundation, and that they're both very good for managing gains, capital gains, and unappreciated securities, and are considered as part of an estate plan. So I think with that, we'll now probably turn to kind of what I think of as really the heart of what most of us think about from a planning perspective, and talk through some of the differences. But before we do that, I think we're going to ask Christy to kind of join us again and lead us through a poll and to interact with you and get some feedback from you. So, hi, Christy.
Hi.
We'll turn it over to you, and then you'll let Justin and I know when we should kind of hop back in and start talking again.
Sure.
Thank you.
I'm about to launch a poll for everyone. We'd love to get your feedback. And the question is, I'm going to pop this up there for you. Do you currently work with families or companies who have a private foundation, a donor advised fund, both, or none? If you answer none, there's no wrong answer here. We're just trying to get a sense of what you all are seeing in your current practices. So I'll leave that open for a couple moments here, and then we'll get a sense of what everybody. I see you all responding, so we'll give it another 20 seconds or so. And see, I will just make mention while we're waiting, Justin and Marianne, I knew we would have at least one or two audience members pick up on the fact that you both have Pennsylvania heavy backgrounds, and so we've already had some questions about if the Eagles will win on Sunday, things like that. So
well, we can leave plenty of time to that. The answer is probably no in that regard.
I was going to say, if the Eagles win on Sunday, I think it's a cause for big celebration, right?
Yes, it is, but we don't want to get too political with our football of the Steelers and Eagles here. I know that. So, all right, I'm going to go ahead and close the poll now. Give you 2 more seconds to respond. Looks like everybody's dialed in, and then I'm going to share it so you all can see. So what we have, Marianne and Justin, just in case you can't see this, so 9% of respondents said they have clients and companies who are working with private foundations, 15% with donor advised funds, 65% with both, and 11% with none. So that's kind of goes to what I was kind of talking about in the intro, that it really isn't an either or question anymore. That's kind of a false choice. So I'm going to go ahead and hide this now, but thanks everybody for sharing, and I'll let you all continue and take it away.
Thanks, Christy. So the data or the results of the poll are really interesting, and kind of part of what we talk about in terms of having compatible vehicles and donor advised funds and private foundations working together. And to know that 65% of you on the webinar today are really supporting clients who have both charitable vehicles. It's just kind of a reinforcement of where we come from at Foundation Source in terms of thinking about the family and the giving plans, short-term and long-term, and thinking about how the donor advised fund and private foundation work together in terms of tax treatment as well. I think Justin, from here, I think we're going to move into some of the legacy considerations and also grant making considerations. And with that, I'm going to put myself on mute and kind of turn it over to you. But if you want to pop anything back over to me, I'm here.
Yeah, thanks, Marianne. It was good to see the poll results. That's really indicative of what we're seeing out there as well. Number one, we're seeing a lot more people have a charitable vehicle in place instead of just what we call checkbook philanthropy, just writing checks here and there, but being more structured about it. So the fact that over half of the audience has clients, or possibly they have their own foundation or donor advised fund, is not surprising. We've seen just an explosion of both vehicles, people wanting to do more and wanting to be more thoughtful about it by setting up an actual vehicle for it. So good to see those numbers. Yeah, so let's talk about the legacy considerations, which are important for both private foundation and donor advised funds. So what we're talking about here is, giving beyond your own lifetime, maybe getting your family involved. So with a private foundation, yes, absolutely, you can keep it going as long as you want to. The entity is under your complete legal and financial control. With a donor advised fund, though, that's not the case. That's just the way they're set up. So the governing body is in charge of the assets. You've signed over those assets to them. We'll talk about foundations. You can actually wind down your foundation and give the money out if you don't want to continue with the foundation model. But actually, so for a donor advised fund, it's more limited. You can keep a foundation going for as long as you're able to, as long as your financial advisor is able to make prudent investment decisions and you're able to meet the 5% requirement. With the donor advised fund, it's much more limited. For some people, that's attractive. But not all DAFs, as we call them, are the same, and not all foundations are the same. But generally speaking, most DAFs will end after one generation or maybe two. Also, the ability to really structure the organization, as it were, the board of directors or the trustees. Again, with the foundation, it's your entity. You can do with it what you want to. You can incorporate with one individual or multiple family members, or even friends of the family who want to become involved with the foundation, for those families that don't have children. DAFs, you don't have the ability to do that. You can't have your own board of directors or trustees. That's just the way it's structured. But it's about what's important for you and your family, and the ability to keep it going. We have a lot of our clients who are very private, and or they don't want to quote unquote burden their family with the foundation. So again, you can sunset it after a certain number of years if you want to, but those are some of the considerations as far as whether it's going to keep going in perpetuity or not. And the next section would be on the grant making considerations, if we could advance. So another area of consideration between the two vehicles, because they're pretty different as far as these are concerned. So donor advised fund, for those of you who aren't aware, and it sounds like by the audience, most of you do know this, but it's generally limited to donations to a 501c3 public charity. And for some people, that's great. They don't want to do much more than that. And with a foundation, you can write checks to 501c3s all day long, but you can also do some really unique things that a lot of our clients avail themselves of through Foundation Source. We do all these things behind the scene to set them up, such as scholarships, fellowships, and you get to choose who the recipients will be. We don't have it here, but we also have the ability to give internationally as well. Some DAFs do that, a lot of them do not. The second one, talking to you from San Francisco right now, so I can tell you that our client advisors at Foundation Source are very busy with the wildfires here in not only Northern California, but all over the state and all over the Pacific Northwest as well. So you're not relegated to just 501c3s. You can actually give money to families, and obviously they're not qualified 501c3s, but the foundation model allows for you to give food, clothing, shelter to someone who's directly affected by a hardship or a national emergency. COVID was declared one, so you can give money in that regard too. But we're seeing a lot of our families, instead of having the money trickle down from a charity to a family, they're actually buying supplies and food and giving it directly to families. And we have a system in place with the IRS that we can qualify those grants and get the money out very quickly in situations such as this. Lastly, the differences on DCAs, we call them direct charitable activities. A donor advised fund, again, think of it as giving checks directly to existing charities. With a foundation, if you want to, you can do very unique things, get your hands dirty, or get down into the grassroots of your neighborhood. Typically, we see our clients, they come on board, especially if they're new philanthropists, they'll write checks for the first 5 years or so. Marion, you may see this as well. But once they either A, have more time, or B, are more familiar with the foundation model, they'll start to do more hands-on things. So we see people through their foundation doing like a coat drive in the wintertime, soup kitchens directly through their foundation, those kind of things. And we're behind the scenes running it for them. And it really is impactful. We talked about getting kids involved and having the kids there to hand out a turkey at Thanksgiving to those in need. And that's something that's going to stick with them for the rest of their lives. And it's got that stickiness to it as opposed to just writing a check to an organization. But again, most of our clients have both for various reasons. They're both good vehicles for certain things, but the ability to do these really unique hands-on things is really a game changer for a lot of people. And we could go to the next one, which still involving grant making. So as you may know, a foundation does have to give out 5% of its balance from the previous year, or it's subject to a penalty. Now you can look at it as one of two ways. It's a commitment that you have to make sure you're meeting every year, but also most of our clients and most foundations in general are giving out more than 5% regardless. So it's good that that's in place because it's making sure money is going out into the community. A donor advised fund currently doesn't have any sort of restriction to it. So most are giving out, but there's no requirement. There has been some talk about the legislature putting a restriction on donor advised funds, the same as a private foundation, but as of yet, it hasn't been enacted. The next one is kind of interesting as well as far as paying expenses. So you cannot pay expenses through a donor advised fund. It's much more limited, but a foundation does allow you to do that. So and we kind of encourage our clients to do this as well. So if you want to do a site visit to a charity that you're working with, if you want to travel to the East Coast from the West Coast and attend a charitable event, the foundation can actually pay your expenses for your hotel, your meals, your flight. Obviously, there are restrictions. Foundation Source was started by a couple of attorneys, so we're a group of attorneys and CPAs going through the minutia of your receipts and making sure those that are qualified to be reimbursed are able to be so, but those that are not are left out. So for example, spouses can't be, their travel can't be picked up. flying domestically, you can't do it first class, but going overseas, you can. We actually had a family of ours that we work with, actually 2 smaller foundations, went together and teamed up. They wanted to build a school in India, and the first thing was to dig a well. So they, again, teamed up and did it together, and actually were able to fly over there and check on things as they were getting up and running. And again, we were able to process those expenses for them. Lastly is the ability to give anonymously. So with a foundation, it is a public tax return. So if someone was inclined to, if they had some free time on their hands, they could go to a couple public websites and type in the name of the foundation and see who they were giving their money to. That is not possible with the donor advised fund. Everything that comes out of there is very anonymous. So if you're someone who really prides themselves with privacy and anonymity, that's a consideration to have in mind. We have a number of celebrity and famous clients, and that's something that we take into account for them. For them, with their foundation, you're actually able to give from your foundation to your donor advised fund, so you can make an anonymous grant from your DAF and no one can find out where it's coming from. So that's a kind of a unique way that we've set up for people who want to keep their granting anonymous.
Great. Hey, Justin, this happens to the 2 of us when we start talking about charitable giving. There's so much to say that, and so many ways in which we can talk about how we've worked with clients and advisors that we start to run short on time. And so I just wanted to do a quick time check for us. I'm terrible at keeping track of that. So I'm really pushing myself here. So I think maybe in the interest of time, rather than us talking through another kind of scenario where the private foundation and the donor advised fund fit for people, that we'll kind of maybe move on to tax considerations. And we want to allow enough time for Q&A. So I'm going to kind of move us through, and if time allows, we'll come back and talk about some of those other scenarios. So kind of when we began, we were talking about, the client lens and the advisor lens. And this is the part where, we definitely are coming into the advisor focus here, where it really starts to be about the holistic view of the portfolio and how best to structure contributions and think about the tax treatment. So donor advised funds and private foundations have different tax treatments. Rather than going through what is up on screen in detail, just acknowledge that private foundations have receive a lower deductibility of contributions than donor advised funds. And this ties back to, again, the structure, form, and intent around this. Private foundations kind of ultimately offering the maximum control and benefit, not in a self-dealing way, but control over assets, grant making, governance that comes with a private foundation, and kind of the payback on that comes in twofold. One, a lower deductibility, and 2, that the IRS imposes an excise tax on realized gains in the foundation that doesn't come over to donor advised funds. So, definitely wanted to make mention of the tax treatment and also the difference in the excise tax that private foundations have and donor advised funds don't have. I think I might be around 14 or 15 years of doing this at Foundation Source, and honestly, it has been only one time where the difference in tax treatment really drove someone toward a donor advised fund versus a private foundation. But I'm sure there are plenty of situations where that doesn't happen. But again, going back to the consideration that we talked about earlier about how tax treatment is on the scale of the Maslow scale for charitable giving, that falls kind of lower on the list. I also, again, here's where we're kind of talking about the excise tax piece of this. but wanting to acknowledge that, you know, donor advised funds and private foundations are distinct in terms of their ability to, you know, accept and hold assets. I would characterize it as, you know, private foundations being able to accept and hold the broadest class of assets in versus the donor advised fund, which, you know, will oftentimes be able to accept certain classes of assets, but then there is a requirement that those be sold after their contribution. You know, that can become particularly meaningful when there is, you know, real estate that the family wants to hold on to, business holdings that are important to stay within the current ownership structure. And beyond that, you know, let me just kind of maybe ask you, Justin, for a moment. Is there anything else either on the kind of investment side or deductibility side that I think is important, that you think is important to draw as a distinction between the two?
No, I think you pretty much hit everything. It's just, again, the ability to hold different types of assets is really attractive to a lot of clients for a foundation. You know, we could go into, I could tell stories all day. It's about clients who have, you know, artwork, baseball card collections, those sort of things. Real estate is a really popular one. So just the ability to hold those types of different things and the ability to have them, you know, valued correctly in a foundation is something we help a lot of our clients with.
Great, thank you. Again, I am just also want to say that, you know, we picked out certain attributes of the donor advised fund and the private foundation here that in our experience most often come into the planning consideration. There are many more distinctions between the two. We often, you know, are asked this question about, you know, hiring family members as staff people for the foundation, you know, if not today, you know, a generation from now. And that is, you know, distinct to the private foundation versus the donor advised fund. And then from a planning perspective, two other points. One is that the IRS allows for a private foundation, as you mentioned, Justin, to make contributions from the private foundation to the donor advised fund, but the donor advised fund cannot make any grants or gifts or contributions, can't move assets from the DAF back over to a private foundation. So from a planning perspective, and again, you know, being mindful that you know, many of the people on this call work in both vehicles. This may not be relevant, but when people say, listen, we're starting with, you know, X amount, fill in the blank on what that amount is, you know, should we, and we're going to begin with one vehicle, where do we begin? Oftentimes a family will lean toward the private foundation because of the conversion capabilities if something is going to shift over time. Christy, I'm gonna maybe ask you to jump back onto the call here and help us with a final poll, and then Justin and I will kind of try to move through the when a donor advised fund, when a private foundation, when both, in like 30 seconds or less. So Christy, to you.
Okay, great. So I'm gonna launch this poll now. So how likely are you to advise a year-end charitable giving plan for your client? We'll just leave it open for, maybe 25, 30 seconds this time, just in the interest of time. So I see everybody logging your answers. We'll give it another 10 seconds or so. All right, I'm gonna close it out in 3 seconds. All right, there we go. And I'll share that for everyone. So responses, 48% highly likely, 31% somewhat, 6% not at all likely, and 15% unsure. So there you go. Let me hide this, and I'll turn it back over to you.
Sounds good. Yeah, I'd like to see those numbers. It's definitely a good conversation to have. Again, it opens up so many other relationship areas with your clients and prospects.
Great, thanks, Justin. I think that maybe what we'll do very quickly is, we're do the, when a DAF, when it's like clearly squarely a DAF, when it's clearly squarely a private foundation, and when it points to both of those. So do you want to take us away on the DAF?
Sounds good. Yeah, and very quickly, you can tell when you're talking to your clients which is they're leaning. If they want more limited levels of contribution, so they want to put a smaller amount into it, DAF is a good idea. That being said, for some reason there's a misperception that you need to put 5 to 10 million in a foundation to start it up. With Foundation Source, that's definitely not the case. You can set up a foundation of $500,000. That being said, we have clients in the billions as well. It's all over the map, but smaller amount, your comfort level with relinquishing control. So a lot of these people highly, motivated and successful. So the control issues can sometimes be there, but if they're okay with that, then a donor advised fund is a good fit. More narrow styles of giving. So again, just giving to the 501c3s, and also the desire for complete anonymity. If that's very important, then a DAF would be a good fit. Going towards the foundation, having control, again, no surprise that many ultra high net worth individuals love to have control over many aspects of their lives. Also the ability to set the governance structure as, who you want in the family in there, who you may not want, the black sheep, etc. Also continuing in perpetuity, if you want to keep it going. And as I think we mentioned before, just because you set up the foundation, it doesn't have to keep going. You could wind it down at some point if you choose to do that. Donating and holding a wide class of assets, so not just cash and stocks, but also K1 real estate. We talked about that. And lastly, flexibility in giving. So that would be, international giving, scholarships, et cetera, et cetera. So Marianne, those are the clear-cut bellwether things that we look for in those conversations. I think you'd agree. When is it a good time to maybe think about both?
Great, thank you. So it is really, again, looking at the donor advised fund and looking at the private foundation and what are the strengths of both of those and how those fit into a client plan. I think when there is a need for balancing control with anonymity, and again, control, it is across assets, across investments, investment management, giving, governance, and as you pointed out, control is a really important thing for families of wealth and particularly business owners. So recognizing that not everybody wants to have a splash of publicity or find their way onto the public radar, thinking about the blend there. The maximizing the tax treatment relates to having both the private foundation and the donor advised fund and being able to take deductions for both, so that if you have a year where there's high capital gains, you really want to again try to offset the gains, and using both vehicles in tandem allow for the best tax treatment. And then the final piece is to think about the spending plan or the giving plan for the foundation, and knowing that both the donor advised fund and the private foundation have a place in managing that spending plan, because private foundations have a required distribution requirement, right, a minimum distribution requirement, and donor advised funds don't. They philanthropic families will often look at the intended gift or grant and where's the best place for making that grant. Again, thinking about the distinctions of both. With that, Justin, I'm gonna again ask Christy to come back and join us. Hello.
Hello.
And we're going to kind of move to the question and answer period. So over to you, Christy.
Okay, great. Well, we didn't just get football questions. There were a couple others that came in that were relevant to our discussion today. And one of them really goes to function. So if we kind of, or the form of a private foundation. So this one says, does it make sense or is it possible to obtain 501c3 status for a private foundation? So can you talk through that a little bit more about private foundation status with respect to the IRS?
Mary, do you want to grab that?
Sure, I can do that. So the private foundation is required to apply for its tax exempt status. And so we do that through a 1023 application for determination of tax exempt status. At Foundation Source, we have a process for doing that. Attorneys also have processes for compiling that information and submitting it to the IRS. That 1023 really is the IRS view into the foundation from a funding perspective, an activity perspective, governance, and for them to really validate that the foundation is in fact going to be charitable in its activity and purpose. So the question as I hear it is maybe one of, is it realistic to expect to get determination from the IRS? And I would say it goes back to what the intention is of the foundation and kind of all the facts and circumstances around it. At Foundation Source, we have prepared in excess of 1,000 applications for determination, and all of them have resulted in a favorable determination. I think, during this environment of COVID, the turnaround time is variable. So the good news is that determination is retroactive to the inception of the foundation. So as we're nearing year end and we start to think about what's the best vehicle, where should my client be, it is realistic to set up a foundation, to fund a foundation, again, kind of putting it through all the tests of reasonableness, like does it pass the sniff test? And assuming that the funding, will go in to be able to take the charitable deduction this year and then know that the determination is retroactive. So I think that's a little bit of what goes into it, and then people weigh their comfort level around that.
Great.
Did that
Thank
hit the
you.
mark?
Yep, it did. It did.
Okay.
Thank you. And we have time for 2 more questions. So I'm gonna rapid fire these for you guys. The first one, or there's actually 2 questions. So I'm gonna ask them together because they're related. So it's talking about private foundations contributing to scholarships to individuals for emergencies, and are those funds still tax deductible? And the related one to that is if a private foundation doesn't want to establish their own scholarship fund with the IRS, but are they able to give to a public foundation or a public charity that has an established fund, and is that okay?
Do you want me to grab that one, Marianne? Happy to. Okay, so the answer is yes, you don't have to establish your own scholarship program. So a lot of people don't want to go through the process of doing that. It's actually, we do that for our clients. It's actually a lot more to it than you would think. There's a lot of tests that have to be done, but you can give to other organizations. And yes, think of it as a grant going out of the foundation, even if it's in the form of a scholarship or any other type of grant. It's considered a grant. It's coming out just like the expenses would be considered, something meeting your minimum distribution requirement. So the answer is yes.
Okay, great. And we're at 3:59, so I'm going to go ahead, Marianne, if you want to advance to the last slide, just so that folks can here's the info@Foundation Source email address and our 800 number. If you have additional questions that you did not put in the chat, please feel free to send them. If you have questions about CE credit, you can send those there as well. I manage the CE credit, so you can also email me at crose@foundationsource.com. Anybody whose question we did not have time to answer, we will follow up with you directly. And of course, if you are interested in having a conversation with Mary Ann and Justin, they are always here, and you can reach them at that 800 number as well. So thank you, everybody, for joining today. I will remind you that there are handouts that you can take with you, and really appreciate Justin and Mary Ann today, and wish everybody a wonderful end of the week and weekend. So this concludes our broadcast today. Thank you.
Thanks, everyone.
Thank you. Bye-bye. Take care.